Hello, everybody. Sorry it's been so long. Got through the Black Friday rush there and Thanksgiving, so I figured I'd give another video here. It's been a while. This video, I'm going to talk about the difference between an open-ended lease and a closed-ended lease. Essentially, most of the leases today are what they call closed-ended, which means the residual value, and that number is the amount you can purchase the vehicle for uh, at the end of the 3 years or however long the term, what you can sell it for, take your equity, what you can trade it for, take your equity, or that's the amount that is the residual value when you go to turn it back into whatever manufacturer you lease your vehicle from. An open-ended lease is where that residual value moves and it fluctuates. So during the period of the lease, so for this instance, we'll say 36 months, the residual value actually goes up or down. Most cases it goes down. A lot of times when that used to happen back in the 80s and 90s is because the manufacturer would drop fleet vehicles into the open market for sale, and it would drag down the value on the residual on your current lease. So you would come back in an open-ended lease, presumably to turn in your vehicle. Let's say you had a residual of 18,000 on the vehicle. It now was 15,000, and you would owe $3,000 in the difference in the residual value. Now they are called closed-ended leases, where that residual value is fixed. So at the time of purchase, that number is fixed for the whole lease period. So with Toyota, it's usually 3 years. You lease the vehicle for, so you have that number, and it's fixed from the time of purchase for the 3 years of the lease. That's what you can buy it for. So if it's 15 grand when you lease the vehicle, it's 15 grand when you come back. So closed-ended leases are very nice, offers a lot more protection to the customer. The manufacturers, especially Toyota, have gotten very good at forecasting the residual values based against market value. The idea is Toyota would not want you to lease a vehicle if they knew you were going to be upside down at the end. So Toyota has to design it in a way to almost guarantee that you're either going to break even or wind up with some equity, because unhappy customer means you're probably not going to want to lease a vehicle again. So with that lease, you have the four options of purchasing the vehicle for the residual value. You could sell it on your own, and anything above the residual value you get to keep yourself. You could trade it. We pay off the residual value, and then you get the difference towards the purchase of a new vehicle. Or if you'd really like, you can turn in the vehicle and walk away. The only disposition to that is they charge one fee with Toyota. It's called a disposition fee. Kind of did some forecasting there. And that is what they're going to charge you to pick up the vehicle, inspect it, and send it off to wherever they're going to auction the vehicle off. So that's what the disposition fee is, and you only pay that if you do turn in the vehicle, and you pay it at the end of the 3-year lease. Aside from that, leasing is a great option for people who love to get a new vehicle every 3 years. So that touches base on the difference between a closed-ended and an open-ended. I would not recommend doing an open-ended lease. I do not think it's beneficial, but you're welcome to test the waters yourself. So I will be doing a lot more on leasing. It's not as complicated as everybody thinks, but I will keep doing videos to explain the benefits. So have a great day.